Hi class, and welcome to this video, which is going to run through some common transactions that you might not have seen before that you'll be asked to record in your general journal and general ledger. These are transactions that you will find in chapters 6 of your Macmillan textbook, and the chapter 5 runs through the principles of general journal and general ledger. What do I hope you achieve out of this video? I hope that you can record these transactions in a journal, ledgers, and that involves identifying the transaction impact, which is debits and credits. By the end of this video and we practice, we should be able to say that we can complete the following. We can record the contribution of assets and liabilities to commence a double entry accounting system. You can record the establishment of a double entry system. You can record the withdrawal of assets for personal use, donations of inventory, and you can fix up errors, so complete correcting errors in this. This video covers these 5 transactions, and I'll try and put some bookmarks in the video so you can skip to the one that you find the most useful. So let's remember this accounting process. We will have source documents to start off with, or in accounting, we are giving you the transaction. And from there, you must record it in a general journal, your day-to-day book that records the debits and credits. And this is your instructions for the third process, which is your general ledger. And that's really what we're going to focus on today. How do we identify the information recorded in a journal and then post it to our ledger? What do you need to be an expert in this? You need to be an expert at debits and credits. Remembering debits equal just the left of the ledger, credits equal right, and your debits must always equal your credits. And they will represent increases or decreases of your elements, your assets, liabilities, owner's equity, revenue, and expenses. But there is specific rules whether it's a debit or credit for an increase or decrease. Now you have a table, or as always, at my class, you can use Paler to understand this, where the top is the increases, the bottom is the decreases. You must remember just one. I always recommend assets going up is a debit, and then you fill in the gap. So hence your assets going down is a credit. And then you just fill in the pattern of rotating debits and credits. If you can remember this, the table, Paler, whatever you're using, you need to know your debits and credits to be able to record these transactions. And in this video, we will make the assumption that you know this. So let's go through these transactions one by one. The first one we're going to talk about is a contribution from the owner. Often a business will do 2 things that we need to record. Sometimes a business owner we must record in the follow the accounting process when the business is created. So a business has been created and been recording information, but is now decided to go and implement a proper accounting process with debits and credits. Or other times a business owner contributes assets and liabilities to the business. Each time the process is the same. We are going to assume if an owner contributes assets and liabilities, or if the business owner is going from no recording to some recording, that we are going to increase our assets and liabilities as a result of this transaction. And when this happens, we record this in our general journal. When an owner contributes multiple assets, we combine this in a single general journal entry. This assets being contributed is going to not only increase our assets, but will increase the owner's equity through an increase in the capital. And the capital account will list each asset individually. So we need to be thinking of the impact in this transaction as our assets will increase, and that will be a debit. And our capital will also increase, which is a credit. If we have liabilities being contributed, and that might feel a little bit weird, a business owner might transfer over a loan, or we might be just creating something from scratch, then the business owner takes over the obligation of that loan. This is going to decrease the owner's equity, or how much the business is worth, and a decrease is a debit. So if a liability is contributed to the business because the business is taking over the obligation, we are going to have a liability increasing, which is a credit, and our owner's equity capital is going to go down, which is a debit. So let's look at an example of this. So apologies, let's now think about what the value is going to be that we record our assets and liabilities. There is a little quirk here. When there is a non-cash asset contributed to by the owner to the business, we are going to adopt the fair value. That is the accepted value at the time of transfer. So an example could be, let's say the business owner has a motor vehicle. And the motor vehicle was purchased by the business owner for $50,000. But this happened 10 years ago, and we now think that so 50K purchased, but we think the fair value now is $12,000. When we transfer it, it would not make sense for us to reward the business by saying it now is a $50,000 vehicle when the fair value is $12,000. We adopt the accepted value at the time of transfer because this is more relevant, and this means the accounting reports will include the accurate information that is useful for decision making. Now we acknowledge that this is violating the verifiability characteristic that says we should have source documents because this provides the evidence to make sure our accounts are free from bias or errors. The accountants have made a decision that it is more important to be relevant and adopt fair value than worry about a source document, because in this case, when the owner transfers the asset, there is not a source document. So let's look at an example of when someone contributes something to the business, or if they establish a double entry system from scratch. Here we have an example on the 7th of March 2020. Edward Epping contributed the following assets and liabilities: cash of $10,000, vehicle of $25,000, a loan of $15,000. Now, before we go to our general journal, we can actually work out what has happened. We all know that these are increasing, so we have an asset increasing, which will be a debit, another asset increasing, which will be a debit, and we have a loan increasing, which will be a credit. And we know that the difference between these, the business worth, will be our owner's equity that increases, which is also a credit. So if you do that, and we look at the difference, we can start to work out our general journal. We know that we have a template. If an asset is being increased, we're going to write the asset and recognize that it is increasing our capital. And we know that liabilities are going to decrease our capital. So in this case, on the 7th of March, we're going to list the assets first that have been contributed. Our cash at bank of $10,000. We recognize that as a debit because our asset is increasing. Our vehicle also goes up, which is an asset increasing, so it is a debit of $25,000. We have a loan, which we indent because there is the convention that we do our credits as indentations, of $15,000 because this is a liability increasing. Now this does not balance, so we cannot stop here. We also have to balance it with a credit of $20,000 because both sides now equal $35,000. Our owner's equity or business worth has increased by $20,000 because of this transaction. And that makes sense when you think it through. We have $35,000 of assets going to the business, a $15,000 loan. That means our business is worth $20,000 more. We must do a narration which tells a short explanation of this and include the source document. Assets and liabilities contributed by the owner. Memo 1 is absolutely appropriate. We don't need to put the dollar amounts in because that's in our general journal already. And we don't have to list the assets and liabilities because that's going to be too long an explanation. And we know this from our details section anyway. We then can use this information to post in our general ledgers. Cash at bank was an asset, and we do our debits on our left and credits on our right. And our cash was a debit, and our cross-reference here is capital because if you think back to the first template, we do essentially split them up. Our asset is our debit, our capital is our credit. We do the same thing for our vehicle. Our loan also is recorded, but here it is a credit because that was recorded on our credit side. And if we look back to our details, when we record a liability, our other side is our capital. And remembering the cross-reference is recording in the details section the other side of the transaction. Our capital is impacted 3 times because each time we've had an asset being updated or a loan updated, it has been recorded. And this is how we record in our accounts the contribution of owners, the contribution from owners of assets or liabilities, or if the business is starting from scratch. So now we come to accounting for drawings. What is drawings? Drawings are a withdrawal of an asset by the business owner. Now this could be either cash or other assets. This is typically for personal use, and typically the most common one they withdraw is cash because the person can use that cash to buy the things they want. Now under the entity accounting assumption, when assets are taken away from their business, they are no longer under the control of the business, and we must record it because our assets are going down. Because remember, it is only a business asset if it is under the control of the business. These ones are no longer. This is going to then result in our owner's equity going down, as it is the opposite of a contribution. So if we think this through before we go through a transaction, our assets are going to go down in this transaction, and this equals a credit, and our owner's equity is also going to go down, and this is going to be our debit. Just like here. We are going to record our details as drawings and assets. These are going to be our general ledger details. We're not going to say asset, but the actual asset. But as we recognize, drawings going down is a debit, assets going down are a credit. And I probably haven't explained that well because we're going to have a little quirk. The reason why our owner's equity goes down is because our drawings are going up. So if drawings go up, that is going to result in our owner's equity going down. So let's go through an example. In this example, 2 things have happened. On April 5, the owner withdrew $500 of cash for personal use and also withdrew inventory for personal use. The cost price was $100, the selling price was $200. So the April 5 one, relatively simple. We have a drawing and it is $500, and our cash at bank has gone down by $500. This results in our owner's equity going down and our asset going down. And we can use our narration to explain this. The owner withdrew $500 for personal use. You probably didn't need to say the $500. You could say cash. Doesn't really matter. The important bit is we have recorded the source document. On April 6, we also have a drawing, this time of $100, and that might have been a question, which one do I use? And our inventory has also gone down. And the owner has withdrew inventory for personal use. Why did we record the inventory at $100? Because remembering back to year 11, inventory is always recorded at the cost price. And we'll go through that a bit more in future classes. This would then mean our ledger will follow those perfect instructions. We know our cash at bank, which is an asset, went down, the assets going down are credits, so we record it on our right-hand side. Because if we remember, credits are on our right, debits are on our left. So we're going to record our cash as a credit on our right-hand side. We are going to record our inventory on our right-hand side as a credit because that also went down, and our inventory is also an asset. Our drawings has been recorded twice because 2 times this occurred. And remember, our cross-reference is the other side. So because I did a credit, I'm going to write in my cross-reference the debits that were recorded to equal that amount. In my drawings, I'm going to record the credit that equaled that amount because I've recorded a debit. So in summary, withdrawal of assets are going to reduce our assets and reduce our owner's equity as a result of drawings increasing. One that is a little bit quirky is if we have inventory leaving our business, not for personal use, but because of a donation. This is a different type of transaction. Why does a business provide donations? Businesses often do donations, maybe for local schools or charities, and they do this via donations. They might donate some inventory that they were going to sell for raffles, fates, etc. Now, they often do this out of the goodness of their heart, but they also often receive publicity from this that is positive. So when they do this, we need to recognize our assets leave our business, but we're going to recognize this as also an advertising expense. Now, because there is no sale, there is no GST attached, but we do need to recognize a transaction here. What is our transaction? Our asset will clearly go down. Assets going down are credits. We are now going to have an advertising expense, we'll just write it as E, and that is going to be something that goes up. Expenses going up are debits. And it is going to look like this in our general journal. Our advertising is an expense. Expenses going up, because expenses have gone up, is going to be a debit. An asset going down because of a donation is going to result in a credit. One thing to note is because we are talking about inventory, this means that anything that is being donated, we record at cost price. So let's look at an example. On the 7th of April, the owner donated some inventory to the local primary school and received free advertising. The cost price of the donated goods were $400. The selling price was $700. Now we recognize instantly, because it's inventory being donated, the number that we are interested here is the $400. And we're going to record this as advertising, an expense increasing, being a debit of 400 and our inventory being an asset decreasing being a credit. We will always do a short explanation as a narration. Owner donated $400 worth of inventory to the local school for the annual fete and put our source document number there. We will then pick up this information with our debits being our left, our credits being our right. Oh, what am I doing? And record this in our general ledger. So our advertising is going to be recorded on our left-hand side in our ledger. Inventory is going to be recorded on our right-hand side, like so. Again, remembering we've done a debit here and a credit for inventory. So debit in our advertising, inventory is written because in our cross-reference, because that is our credit. Advertising is listed in our inventory as our cross-reference because that is our debit, and we are telling the other side of the story. Now we come to the final one, errors. A slightly more complicated one where there is 3 steps to correct errors. We will make errors. Business make errors in their double entry all the time. It is important that we correct the error as soon as possible. If an error is found in the general ledger where there has been a debit or a credit, it should not be rubbed out or scribbled out. We make sure that we don't do this because this might indicate that something illegal or fraud is happening. So we need to have a correct way to fix an error. And to do this, we're actually going to have to do a general journal entry to rectify the error. Now, I want you to remember that debits and credits, all they actually equal, depending on the element, is either an increase or a decrease. Credits also equal just increases or decreases. So if we, for example, say that we have a debit that equals an increase, and I didn't want to do it, I've done a debit that I said there was an increase, and there's no way to just scribble it out. How do I reverse it? I need to decrease that number. What's the only way to decrease that number? By doing a credit. So when preparing a correcting error, the error must be reversed or fixed or removed, and the correct way must be recorded in our accounts. Now, one thing to just remember, if the error was just an omission, we forgot to put it in, you don't need to worry too much, you just make the additional entry. However, if it is not just an omission, we have a 3-step process to go through. And I recommend, even if you are feeling so confident with your debits and credits, that you follow this 3-step process. Step 1, you are going to think in terms of your debits or credits, what was recorded? What was actually recorded when this mistake was made? Step 2, you are going to go, what should have been recorded if it was perfectly recorded? Step 3, you're going to look at and go, how can I fix up? What do I move from what was recorded to what should have been recorded to fix this error? And like many things, examples are the best way to do this. So let's go through a couple of examples. Let's consider this mistake. A payment of wages was incorrectly debited to the advertising account. So we should have put wages as a recorded wages, but we put it in advertising. To fix this up, it will look like this. Wages 300, advertising 300. But you're probably going, where the hell did we get to this? And we would then do a narration correction of error and explain why. Let's go through the 3-step process with this one. A payment of $1,200 for wages was incorrectly debited under advertising. Now, we should hopefully understand already, because the numbers are the only thing different is the numbers, is that this is probably going to result in $1,200 as a debit and $1,200 as a credit. But how do we get there? Step one, we're going to have to say what was recorded. In this case, what was recorded was advertising of $1,200 as a debit. A payment of $1,200 of wages was incorrectly debited under advertising. We also would have done a double entry, and the other side was we would have recognized the payment of cash as a credit. So essentially, when they originally recorded it, they said the expense advertising went up and the cash, which is an asset, went down. What should have been recorded is we should have recorded wages as an expense increasing and cash going down by $1,200. So we then look at this and go, what do we need to do to fix this up? And the first thing you need to go is we actually did half of this transaction correctly. The cash at bank part was correctly recorded. So I don't need to touch that. What I need to do is get rid of the advertising and record the wages. So if I have never recorded a wages of $1,200 as a debit, to fix that up, I simply just record that. But to remove the debit of advertising, the only way to do that is to do a credit of $1,200. I have now done a correcting error that fixes up my mistake, removes the advertising increase by doing a decrease as a credit, and correctly recording my wages increasing. And that's the process that you go through. We could also have one where there hasn't been actually a mistake in what's been put in terms of the details, but the numbers were incorrect. In this case, a payment of $123 for insurance was incorrectly recorded of $132. In this case, what was recorded was $132 of insurance expense going up and our cash going down by $132. What should it have been? The details were correct, but it should have said $123. So how do I fix this up? I need to remove $9 of debits. Now I can't scribble that out for my insurance, so I'm going to credit 9. And I'm going to debit 9 of my cash to fix up the 132 credit. And that's how I fix up that one. I've essentially said I accidentally decreased my cash by 132 with a credit. It should have been by 123, so I need to increase it with a debit of 9 to fix it up. And guys, that is how you record some miscellaneous or transactions you have potentially not seen in the world of debits and credits. This is how you record them in the general journal and general ledger. I hope that by now, after watching this and doing some practice, you can record the contribution of assets and liabilities using fair value. Record the establishment of a double entry, which is the same process as if they've all been contributed. You can record the withdrawal of assets for personal use, record the donations of inventory, which equals advertising. And you can also complete the correcting errors by following the 3-step process: what was recorded, what should have been recorded, and how do I fix it up.